Happy New Year to all of you from all of us here. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a new year rebound. Stocks are kicking off 2025 with tech leading futures higher after a 4-day slump.
One stock that's in focus is Tesla, the EV maker, gaining ahead of a critical report that may show quarterly deliveries hit a new record but failed to exceed last year's total.
And it's not just Tesla. Bloomberg Intelligence has a list of 50 companies worth watching in the year ahead. We'll highlight just a few. That and more coming up. Let's take a look at where markets are trading on your first trading day of 2025. Green across the board right now. Of course, we had a brutal finish to 2024. Wouldn't know it by looking at the movement today. You can see the S&P 500 of about 0.7% before the bells ring. The NASDAQ 100, similar story here. Big tech with a slight lead, though. The NASDAQ 100 of about 0.8%. The bond market, a bid coming into the long end. Of course, we were knocking on the door of 4.6%, maybe talking about 4.7%. Today, though, you can see we're down another 2 basis points at just about 4.55%, Matt.
I'm going to pick up right there where you left off because this could be a problem. This is the 10-year in white for stocks, also for the Fed. In red, you see the Fed funds target rate, and as the Fed cuts, the 10-year has risen. That could really be an issue for the rally going forward.
Up against that 4.5% danger zone. That's my favorite chart of the year, I think, Matt. It's going to lead to a lot of good discussions.
So far this year.
So far this year. There's going to be much more ahead, I know. Some stocks we're watching, as Matt was talking about, Tesla down 1% pre-market. Tesla delivered 495,000 vehicles in the most recent quarter. We expected 512,000. CEO Elon Musk has predicted 20 to 30% sales growth in 2025. We're going to talk a lot more about that, but Tesla below that $400 per share level right now. Also looking at crypto-linked stocks, looking at MicroStrategy on the rise, 2.7% pre-market. It's rising alongside Bitcoin to start the year. Bitcoin is not back above that $100,000 level, though. Also watching Top Golf, Callaway shares surging. Jefferies upgraded the stock to buy from hold, saying it appears oversold amid robust tailwinds. Actually golfing more this year, Matt. It's one of my resolutions.
All right, well, that's fantastic. As I ride Harley-Davidson motorcycles with your husband, you can be out on the golf course. I'm going to take a look. She's not married. I don't know why I said husband. I'm going to take a look right now, just again, at Tesla deliveries because they missed expectations for the quarter, and that means that Tesla delivered fewer cars in 2024 than it did in 2023. So we're looking at fewer than 500,000 deliveries, 495,570. The estimate was for 512,277, and they would have had to post 515,000 to beat last year's record.
That's the thing. Even if they had met expectations, it wouldn't be enough to see growth in 2024. And you can see that disappointment in the stock of Tesla shares, down about 3% or so right now. Of course, it had been higher pre-market in anticipation. That's just one of the stocks we're watching because it is the first trading day of 2024. You think about the last week. I blissfully have been on vacation. I know you guys have been in. Seasonality didn't work in December. Of course, we were down in the month. And
brutal, 2.5%.
Yeah. Typically, you would expect to see a little bit more. January, we'll see if seasonality can be our friend, because typically it's a pretty good month for the S&P 500.
Well, one big problem also is the fact that in December, you lacked a lot of breadth. We saw into December a lot of investors looking at broadening out in terms of the trades they made. The S&P equal weight really lagged in December. And then you had this note by BTIG that I had been watching also. Interestingly enough, less than 60% of the S&P 500 was above the 200-day daily moving average. That was the weakest reading since late 2023, and that divergence, they believe, could lead to some issues early in the year in terms of stock market performance.
All right, well, let's put these questions to Lisa Shalett. She joins us now, Morgan Stanley Wealth Management Chief Investment Officer. Happy New Year to you, Lisa. Thanks
Happy New Year.
So much for joining us. Let's talk first about the big miss. I mean, as everybody got norovirus in December, traders sold off the index to the tune of 2.5%. Typically, it rises 1% in December, at least over the past 25 or 30 years. Why did Santa Claus not show up, and is it a bad omen for 2025?
Well, I think it may be too soon to call it a bad omen, but I'm not particularly surprised that, during the month of December, as folks were looking forward to 2025, they, saw it with some skepticism. And the reason I say that is if you think about what earnings have actually done over the last 2 years, S&P 500 earnings have actually only grown at about 7 to 8%. And yet the forecast over the next 2 years is that we're going to triple that growth rate and increase earnings per share for the index about 25 to 26%. And so I think folks are starting to realize that 2025, when it comes to earnings, is a show me year. And that some of these expectations that are built into these ebullient stock prices may just be too ambitious.
I like that. So 2025, it's a show me year for earnings. Talk about what that means for big tech specifically, because even with that broadening out that we were hoping for, that we saw fall apart in December, this is a big tech driven market. And many are saying that that's what we're going to see again in 2025. What does the earnings picture look like specifically when you focus on that industry?
Yeah, when we look at the tech names, what folks, I think may have slipped their minds a little bit is remembering that big tech had a big earnings recession, actually, at the end of 2022. And that earnings recession set up some very easy comparisons over the last 12 months that allowed big tech companies to put up just spectacular year-over-year earnings growth numbers. In 2025, we think things are going to normalize, and that while big tech may lead the charge in terms of earnings growth, that earnings growth is only going to be about 15 to 18% when you look at the Mag 7. And so that deceleration in growth may surprise some of the, the diehards who are betting on these very high double-digit earnings numbers.
Lisa, I think the other problem here is when you look at the Magnificent Seven and the more than 66% rise they had last year, I want to pull up a component chart on just how much these firms have diverged. You had NVIDIA up 171%, but Microsoft lagged even the S&P 500, was only up about 12% last year. So even within the Magnificent Seven, you are not seeing knockout returns all over the place. How much does even that divergence make a difference, given that NVIDIA comprised so much of the returns for the broader index as well as the Mag 7?
Yeah, I think you bring up a fantastic point, because we are getting to a part of the cycle where differences in individual company exposures is really going to make a difference. Whether we're talking about different exposures to the AI growth story itself, whether we're talking about exposure to antitrust risks. More recently, we've had to talk about exposure to a very strong dollar. These are all issues that I think are going to start differentiating between and among the Mag 7, and this idea that they as a group can trade together and lead the market may falter in 2025.
Lisa, Daniel Morris from BNP Paribas was on Bloomberg Television this morning. He said even if we don't get the 20% earnings growth for NASDAQ that some analysts might suggest, even if it's only 15, markets will do well. Is it possible that we can continue to gain, at these multiples, even with an earnings miss?
So I think this is where the key to 2025 is going to come in. I think it's about having realistic expectations and picking stocks. As opposed to just, looking at the passive index. I think that there are handfuls of stocks and multiple handfuls of stocks in the quote unquote 493 or the non-Mag 7 who are valued realistically, who have realistic earnings expectations and can be expected to generate a good 7 to 10% returns in 2025 because they have the opportunity to actually surprise expectations on the upside. I think what we have to watch out for is where some of the disappointments may be. And our best guess is that the disappointments are going to land in the places where some of the enthusiasm has been most robust.
Well, Lisa, let's talk about some of the factors other than earnings, of course, and the corporate fundamentals. I want to talk about the bond market. We'll be speaking to Julian Emanuel at 9:30. And one of the points that he makes in his notes is that rising long-end bond yields are the biggest challenge to the current cyclical bull market. The 10-year Treasury yield, it's at 4.5% right now. Where do things start to get dicey for you?
I think we're right on the margin of it. Again, I think we've seen it in the last 3 weeks. The weakness in December, in large part, I think can be attributed both to this, Q4 83 basis point move in 10-year yields, as well as, the shift in Fed guidance with regard to their expectations for only 2 cuts next year. As you, buy into this vision that rates will be higher for longer, very high multiple stocks face headwinds. And I think, we started to see some of that, especially those stocks where, the engine for this earnings growth may be a little bit more opaque.
All right, Lisa, really great to kick off 2025 with you. That is Morgan Stanley Wealth's Lisa Shalett. Let's get a check on these futures. Of course, 20 minutes until the bells ring. You can see there's green in the pre-market, but a little bit less than we had about an hour ago. The S&P 500 currently higher by about 0.6%. Big tech, you can see a little bit better. The Nasdaq 100 up about 0.7%. The Russell 2000 putting up a fight after an absolutely punishing December for the small caps. The Russell 2000 currently up about 0.9%. We're going to go micro next, though, because Tesla in focus, missing delivery estimates by about 20,000 cars. We'll bring you their fourth quarter sales numbers next. This is Bloomberg.
It's getting out of high interest. Look at what's making headlines around the world. A gruesome attack on revelers celebrating New Year's Eve in New Orleans is putting U.S. domestic security back into the spotlight just weeks before Donald Trump is sworn in as president. The tragedy killed at least 15 people. It injured dozens more. And the attack also set off panic in the historic French Quarter and postponed events, including a major football game. Hours later, a deadly explosion of a Tesla Cybertruck outside President-elect Trump's hotel in Las Vegas further rattled Americans ringing in the new year. Morgan Stanley, Citi, and Bank America are the latest lenders to leave the Net Zero Banking Alliance, a global climate group. Following Goldman Sachs and Wells Fargo, the exits come as financial institutions are receiving pressure from Republicans to distance themselves from groups supporting carbon emissions reductions. And the luxury Swiss watch brand Rolex is raising prices by as much as 8% on some of its most popular models after gold values surged last year. Rolex typically raises prices once a year on January 1st. Price increases can be indicative of the demand for premium luxury products, the cost of materials, as well as inflation. Last year, Rolex raised prices by only about 4%. And Tesla's fourth quarter sales figures are hot off the press. They're in below estimates. Let's dive straight in and bring in Bloomberg's Detroit bureau chief, David Welch. So, David, with fewer than 500,000 deliveries in the quarter, Tesla had its first annual decline in deliveries in more than a decade. Is it a demand issue?
I think it is. This has been an issue with Tesla for some time now. Analysts, investors questioning whether there was still great growth in the EV market, which we know there is growth, but it has slowed. Tesla has more competitors. In the U.S. now, GM has a lot of EVs out. Hyundai and Kia do as well. And then in China, of course, they've got big competition with BYD and the other domestic players there. So Tesla no longer has this stranglehold on the market. That's been happening for a while, and I think it's gathering steam. Look, I'm a little surprised here because there was a lot of chatter in the fourth quarter when President-elect Donald Trump was saying he was going to get rid of the $7,500 tax credit on EVs. There was a lot of chatter that people would rush out and buy EVs. We don't have data supporting that people did that, but in any case, we do know that there have been 0% financing deals on EVs from GM. We know that Tesla has been offering discounts in the U.S. and in China. So I thought, given that kind of competition, we'd see some bigger numbers. And so I think that is one of the reasons the stock is reacting so negatively right now. Plus the bigger narrative here that with their first first annual decline in a decade, investors are saying, okay, Tesla's EV sales growth momentum is in the rearview mirror, and now the story is about whether or not they can deliver robo-taxis and get some new models out in 2025 that will regain sales momentum for the EVs.
Mm-hmm. David, if this were any other car company, I would say, okay, what they sell would be the number one kind of thing you look at, the profits they make on that. But you look at Tesla's run up after November 5th, and it has been quite staggering. You saw the stock hit almost 480 by the middle of December, but it's sold off since a little bit. It's still above that November high. One major question is, with Musk's closeness to the president-elect, is there something else that investors are really buying here beyond the fundamentals?
There's a story we broke, I think it was late November, that one of the Trump administration's priorities will be to have federal standards for autonomous vehicles, which you don't have right now, which means it's very difficult to have an autonomous vehicle with no pedals, no steering wheel, no human controls. And that's something that the Cybercab is supposed to have. And General Motors had given up on that idea because it was tough to get that through. So I think investors are looking at Elon wanting to turn Tesla into an AI robotaxi company, and maybe the Trump administration can clear the way for that. And I think there's also sort of baked in here an assumption that whatever it takes to give Tesla an easier road to sell electric vehicles, whether it's preserving tax credits, which Trump doesn't want to do, or getting rid of them because that would make life tougher for the new competitors in the U.S., Elon will get because he's close to Trump. I think that's what's going on here is investors figured, okay, he's close to Trump. He's going to get what he needs for robotaxis, for EVs, and that gives him a lot of space to fly. But he still has to sell cars. So here we are.
When we think about some of the competition, especially from Chinese automakers, particularly from BYD, BYD has seen a lot of momentum with plug-in hybrids specifically. And I've asked this question to Ed Ludlow, and he shouted me down. But could we ever see a Tesla hybrid, or is this always going to be a pure-play EV company?
Ooh.
Oh, I think it's always
spicy,
going to be
huh?
a pure-play EV company.
Thanks, Matt Miller.
I don't look. They don't have engine operations, transmission. That's a huge set of factories and things they would need to do it. They'd have to change their assembly. They could probably partner with someone and do it if they wanted to, but it's just not in their brand to have anything with carbon emissions, and that's what's been their selling point all along. It's just, I don't think it's going to happen. Could be wrong, but Tesla is the EV company, and I think that's where they're going to stay.
I hadn't even thought of it, but I think
it was a provocative question.
I think, look, Elon Musk is not beyond throwing a curveball, right?
Know.
I mean, he's written an op-ed in Die Welt supporting the far-right party in Germany. He's calling for new elections in the UK. I mean, this guy does things differently.
It's a wild card,
He is a bit of a wild card. So that, I think, is fascinating. Look, just to get back to the valuation, David, Tesla is now valued at more than literally every car maker in the world combined, right? I mean, at well over $1 trillion, and you're looking at the Detroit car makers valued at like $50 billion or less. What is it you think that investors are betting on here? Is it AI? Is it autonomous, taxis? Is it a robot? What justifies that kind of valuation?
Well, look, someone over the weekend actually sent me a note saying this has to be the easiest short there is. And look, I'm not going to give anybody stock buying advice. A lot of people have lost money betting against Elon Musk. But I think it's everything you're talking about. So, look, Elon Musk is a guy. He's got SpaceX. He's got a boring company. He's just an executive, an entrepreneur who comes up with ideas. And they don't always work. They're often late to market. But I think investors are just betting on, okay, if Elon says he's going to make an AI company with robots and with self-driving vehicles, it might not happen in 2026, which he's targeted, but it will happen. And he's great at keeping a narrative going, but he does deliver a lot when it comes to technology. He always has a growth story, and investors are looking at him more as a Steve Jobs type of character than just a good auto executive. And so he's got stories to tell that the big older car companies don't have. They're all slugging it out to gain a little bit of market share here and there, selling automobiles. And he's doing a lot of other things. And so look, Waymo, which is Google's autonomous vehicle company, they haven't gone public, but I think there'd be a lot of interest there. People see that as a real growth business.
Right.
And they think Tesla can do the same thing. And look, they deliver when it comes to technology. So that's, all of these things you're talking about, they're sort of hope springs eternal because Elon Musk is a technology person and not just an auto executive.
David, we have to leave it there, of course. That is David Welch of Bloomberg News. You're watching Tesla shares now down more than 4%. And remember, it's been sliding over the past week fairly significantly. Interesting to see how the trade starts. One thing I'm watching out for is actually Tesla's relationship to xAI. Speaking of AI, because if you don't have OpenAI as a public company and you have Tesla as a public company, then is Tesla kind of like a backdoor way? If they build a further and further relationship with xAI, even an investment, as he's been talking about, then is it a way to get deeper into that AI trade?
Well, I think for Tesla, a lot of people in the stock who love the stock are buying because they love Elon Musk and they want some exposure to the Elon Musk universe. And Tesla is the easiest, most accessible way to do that.
And you talk about that often on your podcast with Matt Levine. What's that called?
It's called Money Stuff,
the
just
Money
like the column.
Podcast. I will just point out that a buddy of mine last month, Alex Roy, drove a Tesla in full self-driving mode across the country.
That's
brave man.
He had a cannonball run, and as he did that, driving from New York to California, he only charged for 6 hours. He only needed 6 hours of downtime to charge, which
I
is
wish I
fantastic.
had that all on video. Matt, we gotta leave
Tesla, among the companies Bloomberg Intelligence says are worth watching in the year ahead. We'll highlight a few more later this hour. This is Bloomberg. Nice to kick off the year with a bump. We have futures higher, 20 seconds away from the opening bell. This is Bloomberg Open Interest. I'm Matt Miller. You can see futures up 0.5% on the S&P, about 0.6% on the NASDAQ. Russell 2000 futures up the most, with small caps rallying about 0.9%, at least on the index level. You hear the opening bells there. The New York Stock Exchange, you've got the American Red Cross ringing the opening bell to kick off the new year. Down at the NASDAQ market site, you've got New Era Helium. I think they also do natural gas deliveries, but fascinating company there. In terms of the averages, we had a very tough December, down 2.5% for the month. We were down the last 4 days in a row to, I think, 58.81 to close out 2024. Katie Greifeld, what are we doing for the first trading day of 2025?
Yeah, all that bad news, that was last year. Let's take a look at the board right now on your first trading day of 2025. And I have a lot to talk about right now. The S&P 500, the NASDAQ 100, your small caps, all green right now. Of course, we're taking a look at a 0.5% gain when it comes to the big benchmarks. As Matt said, we had been looking at bigger gains pre-market, but still a healthy start to the new year. You take a look at the small caps. The Russell 2000 was down 8.4% in December alone, so it makes sense you're seeing a little bit of a bounce right now. The Russell 2000 up about 0.8%. Meanwhile, you take a look under the hood. We do have some bad news, and that's coming from Tesla, reporting 495,000 deliveries in the most recent quarter. That was well below the expectations of 512,000, and annual vehicle sales actually dropped for the first time in more than a decade. Now remember, CEO Elon Musk, he's predicted 20 to 30% sales growth in 2025. Many analysts expect that this forecast is a little bit too aggressive given all the headwinds facing EV sales, and you certainly see a lot of pessimism in the stock right now. Tesla down about 4.2%, Sonali.
I'm also looking at some things in the green here, Katie, because we have crypto-related stocks really rising this morning. MicroStrategy among them, up 3.3% as the market opens. You have Bitcoin still below that $100,000 level. It hit roughly $107,000 at the end of last year. But with it back on the rise, MicroStrategy, remember this week, had said that it had bought Bitcoin for the 8th consecutive week. You have to watch next week for that 9th week. Riot Platforms also up nearly 4% as the market opens, Matt.
All right, also watching Topgolf, Callaway, those shares rising on an upgrade from Jefferies. Topgolf is now a buy there as the stock appears oversold. Jefferies said, and U.S. golf activity is likely to pick up from 2024. I know, Sonali, you will be hitting the links. So what's behind that? You're gonna start playing golf more.
I played all through high school. I was actually on my high school golf team. I was the only woman on it. So
things you learn on this program.
There you go. Right at the opening bell. We've got a lot to talk about. So let's talk about, of course, the year ahead. We're going to do that with Evercore ISI Chief Equity and Quant Strategist Julian Emanuel. He has an S&P 500 price target of 6,800 by year end. And I want to do the math there. So you think about, of course, where we are. We're 900 points away right now. What does a portfolio designed for 6,800 on the S&P 500 look like?
Sure. So the first thing, I want to calm everyone's nerves about December. You'll remember that December of 2022 was a miserable month. Stocks are supposed to go up in December. They obviously ended the year with difficulty, but we had a great 2023 nonetheless. So seasonality doesn't always work. Good.
But what was it? Tax loss harvesting?
That was very much the story in 2022. And frankly, when you think about things like small caps, it was tax loss harvesting again this year. It's just that the year was so positive that people were caught up in the psychology of this momentum.
But it didn't end kind of the story of the Magnificent Seven here. And you get into 2025, you saw a sell-off in a lot of those names going into the end of last year, and then you have Tesla this morning delivering with a disappointment. How much does it matter if you see any of those seven start to lag, especially when you consider that Tesla was the third best performer of those seven last year?
So I'm going to tie that question into what Katie just asked about what you need to own for this year. And actually this morning is informative, is that stock, which has been leading the charge certainly since the election, coming off, it really started coming off about a week and a half ago, is typical of the high flyers having a more difficult start of a year after you've been up that much. But what it also says is, and you look at the tape this morning, is that the market doesn't need stock X or stock Y or Z for the broad tape to go up. There's a huge amount of liquidity out there. The backdrop for earnings is favorable. The Fed is behind us. Long term, we think the bull market leaders in general, infotech, communication services, consumer discretionary, the names that are leveraged to the AI revolution will lead in 2025. But we also like small caps because they're going to work in the beginning of the year.
So we have priced in, I think, all of the good expectations for the Trump administration, right? We're super excited about tax cuts. We hope the SALT cap gets lifted. And deregulation is, on top of everyone's mind. But people seem to be pushing away the idea that we're going to get massive tariffs causing a trade war, or that we're going to get these mass deportations. And everybody was holding those signs, right? At the RNC. Like, that was the crux of the campaign. So if you do get those two latter events, does that hurt the momentum that we've seen on the stock market?
It certainly can. There's no question about it. Look, our policy people have been very clear about their view that, tariffs and immigration are likely a net drag on GDP and are likely a net boost to inflation. That's not a great mix. But the thing that we've learned since the election is that the bond market is the ultimate disciplinary tool. Okay, and so from our point of view, and part of the reason we've had this volatility at the end of the year is because coming out of the Fed, we got beyond that 4.5% 10-year yield, where over the last 2.5 years has proven difficult for stocks. The bond market is going to discipline, in our view, the extent to which policy is going to be able to be implemented. And if we all know one thing, is that Trump has proven in the past to be a very market-savvy type of president, and maybe instead of quoting the Dow Jones Industrial Average in 2025, he'll quote the 10-year yield.
Crazier things have happened, as we've been discussing, but I want to wrap this into the context of your bear case, of course. We talked about the base case for year-end 6,800. Your bear case is 5,200. What is the most important element there? Is it the bond market or is it something else?
It's definitely the bond market. And so, meanwhile, in a year where we expect volatility, the fact is that 5,200 number may seem scary, but in light of where we are now, it's actually not that scary, given the fact that in any average year, and that includes up years, the typical drawdown is on the order of 11 to 13%. So, and if you go back to last August, You had that in a couple of weeks, and the markets recovered. That is contingent on the bond market saying we can't really deal with valuations where they are, but we don't think there's going to be a recession.
Incredible, because you pointed out during the holiday season, a lot of people were gone. Not only did we get above one of the barometers you're watching for, that 4.5% level, you've also targeted
the danger zone.
Yeah, the danger zone. Max Kettner at HSBC had called that the danger zone, the danger zone for the market. Look at how far we've come just over the last 3 months. Last week, we did hit above 4.6%. You're watching 4.75 and then 5% as the next key markers. What happens if we blow right through that ultimately? Do you think that this means that risk appetite will just be drained from the market?
It's entirely conceivable. So here's the blueprint. And if you think about this from a policy backdrop, whether it's tax, tariff, immigration, or friction with the Fed even, 2025 is likely going to be a lot like the second year of Trump's first term, 2018. And ultimately what happened in 2018 is that bond yields got to a level, 3% it was back then, where the market was no longer comfortable with the mix of valuation and policy and et cetera. And for us, that's 5% this time around. And as I said earlier, we just think that the administration, and if you look at it, the appointment of Bessent caused a huge rally in the bond market, and that's the kind of feedback we think they'll be listening to very carefully as the year goes on.
All right, Julian, great to have an entire interview with you without mentioning the Fed. Let's not ruin it.
Happy New Year.
Let's not ruin it. Happy New Year. Julian Emanuel there from ISI. Coming up, we're going to take a look at Bloomberg Intelligence out with a report, 50 companies to watch as we kick off the first day of trading in 2025. Happy New Year. This is Bloomberg. Charger. This is Bloomberg Open Interest. You're looking live at the principal room. Coming up, an interview with Nick Pinchuk, the CEO of Snap-on, in our next hour at 10:30 a.m. Eastern. This is Bloomberg.
Welcome back to Bloomberg Open Interest. You take a look at the stock market right now. That momentum we were talking about at 9:30 fading and then some. The S&P 500 only up about 0.2%. We were higher by about 0.8% in the pre-market. Meanwhile, big tech, actually it dipped negative. Now it's back to unchanged. Continue to watch this one because actually big tech had been outperforming the S&P 500. You take a look at small caps though, holding on to gains on the Russell 2000, still higher by about 0.9%. We will continue to watch the big benchmarks closely here, but let's get to our top calls. Some of the analyst action in focus this morning. And first up, Topgolf Callaway getting upgraded at Jefferies to a buy. The firm says that the stock appears to be oversold at a time when the golf market is supported by, quote, robust tailwinds. You can see the stock higher by almost 17%. Next up, JMP Securities downgrading Alphabet, saying it's no longer a buy. The analyst cites the possible impact of antitrust penalties on Google's revenue, down about 0.2%. And finally, we have Goldman Sachs double upgrading Cloudflare to a buy from a sell, saying that it's also raising its price target from $77 to $140. Shares currently higher by about 4.4%, Sonali.
And stocks are kicking off 2025 on a rebound, and it's ending a 4-day losing streak. We are, however, still below that 6,000 level on the S&P 500, but we're going to hone in on certain stocks to keep our eyes on in 2025. Bloomberg Intelligence has compiled a list of 50 companies to watch this year. Tim Craighead, Global Chief Content Officer for Bloomberg Intelligence, joins us now. Tell us how you dove into which companies to keep an eye on, because there are some really large high flyers that have had significant run-ups already last year on them, yet you guys still see some more gains.
Indeed. And equally, there's a number that have come under a lot of pressure where we see an inflection and a chance for change. The overall nature of the list comes from our broader list of focus ideas. These are high conviction fundamental views that our analysts around the globe have, combined with catalysts that we think are coming up that can change the markets focus and view on these companies. All 50 of these have specific catalysts coming up in 2025 that we think are going to make turning points, make inflections.
I see AI there. Obviously, it's something we talk about every day, Tim, and something investors are mega pumped about. Is it still just a U.S. story? Are there European companies, Asian companies working on this as well?
Well, it's interesting, Matt. I guess there are a couple things changing in our mind with the AI story. Certainly, it's been U.S.-centric. There's been a lot of focus on NVIDIA, along with the large language models, and we had some of those on our list last year at this time. This year, we're focused more on some of the enabling technologies, and a lot of those are U.S.-oriented. Think Broadcom with its semiconductors and software driving networks, or KLA with its test and measurement equipment that's quite critical. There's others on the list as well, but there are non-U.S. names. There's a little company, probably not a household name in the States, VAT Group. And of all things, they make valves. And you think, what? Well, their high-performance valves are critical to creating a vacuum, which in turn is critical to manufacturing semiconductors. And so as you see AI in semiconductor growth, it's great for VAT.
And one of the categories you also focus on, of course, is new CEOs. And that was definitely one of the biggest narratives in 2024. All of this C-suite turnover. And what companies are you specifically keeping an eye on as some of those new executives really get their sea legs here?
Yeah, it's always important. There's always opportunities. One that stands out in part because of this and some of the dynamics taking place is HSBC. New CEO focused on not only cost cutting, but really shifting the agenda towards asset and wealth management. This plays in well with our view of China as well, where we see an awful lot of asset flow going from property into markets, and they're primed for this with a new CEO to take advantage. Another one that comes to mind is Norfolk Southern. Now, this one is one where they have a new management in place that's shifting focus towards precision scheduling. We saw that work with UNP, Union Pacific, last year, also with new management. We think the same is going to happen with Norfolk Southern as we look forward.
I think another interesting thing about this, you mentioned all these companies going through key inflection points. You're looking at product innovation here as well as you're making decisions. Talk through which companies have the biggest opportunity to surprise in what they're bringing out to market.
Yeah, this is always a fun group of companies as we look through this year by year. One that comes to mind that hopefully comes to your eyes as well is IMAX. The big screen film company. They are the bellwether for this type of big screen, but it's now being applied and adapted to a broader set of screens with theater operators, and we think that there's a big revenue growth story there. Insulet is another one, smaller cap company in medical devices. They have a wearable insulin patch that's becoming the standard of care that we think will be driving new product growth. And another one on that list that's similar to new products is Tesla. Now, I realize, it's getting kicked a bit today, but the reason why it's on our list is because of what we are looking forward to, and that's a launch of a low-priced car, as well as the refresh on the Model Y. Porsche, interestingly, is another auto company that's on the list, again, for 5 new products coming through, including a hybrid 911. Matt, I think that's one you need to be taking a look at.
Absolutely. I'm down for the all-gas version, but a big 911 fan, and the stock has done shockingly poorly since the IPO. So it's about time Porsche picks up the slack a little bit. Tim, great roundup. Highly recommend people check it out on Bloomberg Intelligence, on the Bloomberg Terminal, and Bloomberg Business Week. Tim Craighead there from Bloomberg Intelligence talking about his list that you can see on your terminal or online. If you are on the terminal, by the way, BI space focus go. BI focus go is the command. Coming up, Donald Trump's return to the White House is dominating this year's Wall Street predictions. We'll discuss what the finance world is expecting in 2025. That's next. This is Bloomberg.
Wall Street predictions for the year ahead, usually defined by a number of economic indicators. But for 2025, the outlooks are dominated by one person, and his name is Donald Trump. Of course, his return to the White House coming in just a couple weeks' time. Bloomberg senior editor Sam Potter joins us now with more. And Sam, you have the task of compiling the year-ahead outlooks every single year. And I guess it's hard to talk about 2025 without talking about Donald Trump.
Yes, absolutely. I have the dubious honor of sort of collating hundreds of these things. And it's absolutely the case that this year, Donald Trump's imminent return to the White House hangs over everything. I think that this is a guy who certainly talks a very strong game in terms of global trade, foreign policy, but also domestic agenda. We've got the red sweep as well, which gives him pretty generous powers. But still, no one's quite sure exactly what will happen, what policies he will pursue when he is in office. So he has added this layer of uncertainty and unpredictability over all the usual outlook calls for the year ahead that we get.
Sam, one interesting part of this is when you think about the president-elect and the DOGE effort, this idea that they're going to rein in parts of the fiscal impulses you're seeing out of Washington, one question remains around what that does to growth. And of the estimates you've collected, it's pretty fascinating. You have Bank of America and Apollo saying that you could get GDP coming in at 2.5% or less, consistent with a soft landing, but Charles Schwab still seeing GDP above 3%. Does that dispersion create an issue when you do have a lot of returns here banking on a pro-growth agenda?
Yes, certainly the action we've seen in markets has been pretty optimistic since the election. I think he is seen as ultimately, let's not call it pro-growth, but a pro-business president. This could be good for listed public assets, good for Wall Street. He's expected to be light on regulation and potentially on taxes. And these are all good things for the business of finance and for listed companies. So on balance, the calls overall, they do lean relatively bullish. I think it's important as well when we talk economic growth and that potential soft landing that a lot of what these outlooks are doing is looking globally as well. And compared to the rest of the world, or most of the rest of the world, certainly, the US is still seen as kind of leading the pack. So it's once again an expected story of US exceptionalism compared with everyone else, compared with Europe, for example.
Hey, Sam, I saw the word diversification. We keep getting these broadening out head fakes. It's almost like betting on European stocks or small caps. Is this going to finally happen?
You have 30 seconds.
Well, I tell you, the idea of diversification here is because U.S. assets in particular are so expensive after the run-up we've had, there is always going to be that caution that you've got to lock into returns or you've got to make sure that you're not caught out. So they're talking hedge funds, they're talking private markets as a way to insulate yourself and insulate yourself as well from that unpredictability that we just talked about, from Trump's unknowns. So it is something they do typically add, though, I have to say, every year. It's got a caveat.
Every year, diversification. Well, you got to stay safe. Sam, thanks so much for joining us. Sam Potter there, coming to us out of London. Coming up in the next hour, Marianne Bartels from Sanctuary Wealth explains why she sees the S&P topping 7,200 this year. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, hedge funds gaining. D.E. Shaw plans to return billions of dollars to clients after two of its funds produced double-digit returns last year.
Trump and Musk back Mike Johnson for House Speaker, but some lawmakers had reservations about allowing him to retain the gavel.
And another threat of a port strike looming. We'll discuss what's at stake with talks set to resume next week. All of that and more coming up. But let's take a look at these markets. Like Matt said, 30 minutes from the opening bell, you can see It's a choppy trade. We're going to get it up, and there it is. The S&P 500 higher by about 0.7%. Of course, we had veered to about 0.2% higher. Even more volatility if you take a look at big tech. Of course, the Nasdaq 100 briefly dipping negative in the last 30 minutes, but now higher by about 0.9%. A very choppy trade on the first trading day of 2025 in the equity market. Things a little bit calmer if you take a look at the bond market. The 10-year Treasury yield lower by about 2 basis points. A little bit of a bid coming into the long end after also a very hectic couple of weeks of trading in the bond market.
Still in the danger zone. Where do we get that, by the way?
Max Kettner,
Okay,
HSBC.
You were off,
Okay.
actually.
Yeah, but I like the term.
He was great.
For any reason. Danger zone. Let's take a deeper dive right now into markets on this first trading day of 2025. We're joined now by Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. And Marianne, we've been in teasing you. We've been touting your target, 7,200. Is that at risk if we see the 10-year yield hold above 450?
If it holds above and gets to 5, yes, I do think you get a correction, but I don't think it stalls the rally. You know, when we're entering 2025, we've got GDP growing about 2.5%, 3%. We're seeing analysts really raise their numbers for the year. I've seen numbers as high as 15% for the S&P 500. And we're already starting to see productivity rise. And part of the whole AI story is to enhance productivity. So I think a lot of stars are aligned. The other big bonus is that we're in a lower interest rate environment, at least for the front end of the curve. And, you know, even though the Fed may be slowing down its rate cuts, rates are coming down, and that's stimulative. And then, you know, talk about this almost $7 trillion in cash on the sidelines. Everyone is not in yet. So I do think that the markets will do well this year. There may still be some bucking. We certainly saw the bull buck going into the end of the year, but I don't think it's going to derail the bull trend for the market.
It's interesting because you think about the bull trend and what will be driving it, and so many investors, Marianne, have been banking on that broadening trade. But I want to pull up this note that we got from BTIG of the breadth breakdown that we saw in December, which they say is either a warning sign or an opportunity. They say they saw a similar setup in late 21, which was foretelling of underlying issues ahead of a bear market in 2022. But similar setups in 1996, 2004, 2014, 2018, there were opportunities ahead of a strong rally. This time, they think it could create some problems in the first half of the year. With that said, you are seeing the S&P equal weight into 2025. First day of trading, get a bid once again. Do you think that the broadening trade has real legs given so many risks that are out there?
So the breadth of the market is a very important indicator to technical analysts, but it's not a timing tool. But there are some indicators out there that help you time the market. One of them is the McClellan oscillator, which actually has given a buy signal on the market. The breadth, the overall trend of the breadth, can peak a year in advance before the markets peak. So that's why it's not necessarily a timing tool. What's more important to me is what is the leadership of the market doing? Because if you lose your leadership, you lose your bull market. And the leadership is tech and tech related. You know, we call them Magnificent Seven. They used to be called FANG because they're spread out in tech, comm services, and discretionary. And I see nothing wrong with the leadership of this market. This leader is very, very strong, and I expect it to be strong, which is why I have such a bullish target for the market this year.
And I do want to bring you some breaking news right now. Of course, it's coming from Hindenburg, taking a short position in Carvana. We don't have much details yet, but you take a look at the reaction in Carvana shares dropping about 8%, with Hindenburg saying it's short. We'll continue to follow that one. But again, the market position, not exactly waiting for details here after that news. Carvana shares down about 8% after the report. You can see they've rebounded a little bit right now, currently lower by 3%.
And they've been on a tear,
exactly.
Right? Carvana was trading for damn near close to zero, 2 years ago, and it's up at 250
it
at its high.
rose last year more than NVIDIA at 284%, if you could believe it.
So obviously attracting that interest from Hindenburg. We'll bring you more details as we have them, Marianne. But let's talk a little bit more about the leadership that is big tech. So clearly, of course, you're not giving up on big tech by any stretch of the imagination. But I'm curious what could spoil the party here. We have a lot of known unknowns when it comes to the Trump administration, what a second Trump administration will look like, when it comes, of course, to the bond market as well, some of those danger zone levels that we've been talking about. What could actually upset the apple cart?
The risk that I've outlined is inflation. If you really start seeing core PCE rise, not only will the Fed stop lowering rates, but the market may even price in that the Fed may have to reverse course and raise rates. That would be a big game changer for me in this market.
So what's your expectation for the terminal rate? I mean, how does the Fed move on from here, or is that really just a big unknown?
Well, the terminal rate is a known rate that's unknown. Nobody really knows what the true level is, but the market is really probably pricing in around 3.5 to 4%. And I think that's where the Fed would like to go, as long as inflation allows it to do that. Because if you look at the services side of the economy, it's really on fire. What's not on fire is the manufacturing side of the economy. And we are starting to see some slowness in employment, which is on watch at the Fed. So I think they want to get to this terminal rate that they're approximating around 3.5 to 4%. But if inflation starts creeping up, they're not going to be able to do that.
All right, Marianne, always great to speak with you, especially on the first trading day of 2025. That is Sanctuary Wealth Chief Investment Strategist Marianne Bartels. Let's get a quick look at Carvana again, though, because it's extremely volatile right now. We were talking about that 8% decline after Hindenburg disclosed its short position. You can see that move has been faded and then some. Carvana shares currently positive, higher by about 0.5%.
So I've been reading through the short report from Hindenburg as well. One of the things that they're looking at is potentially major economic headwinds, because they believe that 44% of loans for cars purchased since 2022 are underwater, and they cite Car Edge for that. That's going to be a theme we're watching, guys, not just for Carvana, but how credit quality performs over the next couple months. You know, we're only 13 days away from bank earnings. Fun little fact. Who's counting, though?
You know, it's absolutely fascinating because used car loans are like double-digit percentages. And, of course, at the end of 2021, 2022, you had used car prices often eclipsing the MSRP of the new version of that car.
Interesting enough, they cite an Ally executive telling them that they've pulled back from Carvana pretty significantly. I would want to see how Ally also reacts to that, because, of course, that is a big customer there.
And we should point out, of course, Bloomberg News has reached out to Carvana for a comment. We will bring you that comment if we get it. But you can see Carvana shares shaking off that Hindenburg short report, down 8% after news broke, but currently higher by about, well, round it up, about 1%. Let's get a look at some of the other stocks moving this hour, though. We'll do that with Bloomberg's Alex Semenova. And let's start with MicroStrategy. That, of course, is one of the big outperformers last year. How's it looking on the first trading day of 2025?
Yeah, it's looking good, Katie. Risk assets are broadly up across the board. It was a little bit of a mixed picture for equities, but Bitcoin back above the 97,000 level. And of course, that's lifting MicroStrategy, which is seen as kind of a proxy for Bitcoin. It was under pressure recently into the end of the year, down the past 5 trading sessions and 23% down over the past month. But obviously an incredible rally in 2024, up more than 300%. And actually, analysts at Bernstein, TD Cowen, and Barclays, their rating on the stock implies further upside into 2025. The Trump administration is obviously seen as embracing crypto, so that should do well for the assets and for MicroStrategy as a result. But on the flip side of that, obviously, as we saw last week, if Bitcoin does move in the opposite direction, that's not a good thing for the company.
Also watching over here because of my personal interest in golf, but also very interesting movement in Topgolf Callaway after an upgrade. Interesting to see analysts now coming back and creating such movement in stocks once again.
Yeah, and indeed, a really big move there, 14% up right now. This is after an upgrade from Jefferies to buy from hold. They say that first and foremost, the stock is oversold. It fell about 45% in 2024, but they say it's oversold, particularly at a time when the golf market is supported by robust tailwinds, which means people like to golf. So that should do well for the company. Their price target on the company is $13 per share. That implies a roughly 65% increase from its last close.
There's a stock called, I'm going to say Nomura.
Yeah, I was thinking Numora, but it sounds too much like the bank.
Just say it fast.
Yeah, and in any case, it's a company that's out with a drug that is supposed to treat major depressive disorder, but apparently in the final stage of trials, it didn't work.
Yeah, apparently it didn't work on people who participated in this trial program. It's down about 80% right now. RBC analysts say that this is basically the worst case scenario for the stock, but they do say that they expect that management will help, recover this trial. They have a diversified portfolio of these types of medication, and that should do well for the company. And also, they're supposed to give additional updates at the JP Morgan Healthcare Conference, which begins in San Francisco January 3rd.
Is someone going to that?
I am.
You're going to that, right?
I am going to that. I'm really
big
excited.
lineup already.
Yeah, no, it should be huge. And of course, we will be expecting that sort of news. People sort of wait to drop their news at that conference. Alex, it's great to see you.
Great to see you guys. Happy New Year.
That is Bloomberg's Alex Semenova. Meanwhile, coming up, a new Congress begins tomorrow, and House Speaker Mike Johnson fights for his political future. We'll have the details next. This is Bloomberg.
Getting out of high interest, a look at what's making headlines around the world. Russia is halting natural gas flows to Europe via Ukraine, closing off a route that's operated for 50 years. The stoppage was a result of Kiev's refusal to extend a pipeline deal because it helped fund Moscow's war effort against Ukraine. The halt will force some European countries to find more expensive gas elsewhere, compounding pressure on supplies and driving up household energy bills. And a Rose Bowl rout. There's been an upset in college football in the playoff semifinals. Top seed Oregon was undefeated before they got crushed by Ohio State last night with a final score of 42-21. The Buckeyes face off against Texas next Friday at the Cotton Bowl. And House Speaker Mike Johnson says he's confident he'll win the leadership post again in the vote scheduled for this Friday. That's tomorrow. Johnson, speaking on Fox News, insisted he has Trump's endorsement.
Let's keep that conversation going now with Bloomberg's Michael Shepard joining us from Washington. So Mike Johnson, he has the backing of Donald Trump. He has the backing also of Elon Musk. But with all of that in mind, how much of a fight are we expecting when it comes to this vote?
That's a good question, Katie, because we have seen this movie before with Republicans trying to elect a speaker with a very narrow majority in their chamber, the House, and the difficulties that they have encountered with that. Remember, back in January 2023, Kevin McCarthy won that role as Speaker after 15 votes. And then when Mike Johnson took the job replacing Kevin McCarthy, there was a 3-week gap between McCarthy's ouster and Johnson's eventual ascension after a bitter fight within the party. And so we see Donald Trump and Musk and a lot of other Republicans, including Johnson, trying to project this mandate and this unity across the party. Yet the spending battle that we saw last month highlighted that there are still some factions within the party that could and risk undercutting Johnson in his bid. He only has a 5-seat majority with which to work. And if he loses more than that, it could be a tough battle for him that could take more than a day or so.
Yeah, I want to step back a little bit and ask a little bit more of an existential question, because you are seeing that kind of fracturing, and you've seen it online with even more supporters of the far right with what you saw with immigration as well. I want to point out that Fox is now reporting that Trump is hosting a rally in Washington on the eve of inauguration. So on January 15th, what they're calling a victory rally at the Capital One Arena in downtown Washington. Mike, what's the mood in Washington days before the inauguration at this point?
Well, Sonali, we have been here. We've been down this road before so many times. Every 4 years, we celebrate the peaceful transfer of power. But 4 years ago, we were thrown a bit of a curveball. The events of January 6th, 2021, really shook a number of people's faith, not only in the security apparatus, but in everybody's willingness to be good faith participants. The hope is that some measure of peace and tranquility will be restored to the process. And this event, on the eve of the inauguration, is another one of Trump's signature rallies where he tries to show support, where he tries to show that he has a wide-scale backing, and he will be bringing together a very friendly and favorable audience at an arena just really blocks away from our news offices here in D.C., the Capital One Arena. This is where all the big sports teams play. So it's a well-known venue right in the heart of town. And the mayor herself had recently met with the president-elect and, really expressed some hope that with the new administration, there will be more workers coming back to the office and hopefully back downtown to help stir the economy here. So there is a mix of trepidation as we think back to January 6th, but also some hope that maybe we will turn the corner from that.
Is there any bipartisan legislation, Shep, that we expect to get done? I mean, there are things like the TCJA that Trump really needs to get passed soon, I imagine, but I'm not sure if he's going to have buy-in from the Dems on that.
He will have a tough time getting buy-in from Democrats unless there are some significant concessions, for example, on things like SALT, the state and local tax deduction. A lot of New York and area and Los Angeles area Democrats would probably like to see that cap lifted. Whether or not they're willing to also accept some of the big tax cuts that Trump is pushing, including a cut in the corporate rate, that remains to be seen. And he will need to actually include SALT in there anyway, just to be able to get some of the Republicans in those blue states, those blue areas as well.
Mike, I also want to point out that during the holiday, many people might have missed it, but you did have Janet Yellen writing to lawmakers here that the new debt limit is likely to be hit between January 14th and the 23rd, which would raise another large issue around the debt limit right around inauguration. How big of an issue is that?
This will be a huge issue, and it'll be one staring the soon-to-be president, Donald Trump, and the new Congress right in their faces right after they take office. Because while the Treasury Department can do some what they call extraordinary measures to keep from throwing the United States of America into default, as we nearly did back in June 2023, which we all remember, those measures only last so long. And the projection is they have probably until midsummer to get this done. But negotiating an increase or an adjustment or a suspension of the debt limit takes months, as we've seen in previous fights between Republicans and Democrats over this issue. And this is something that Donald Trump, right before the holiday, you'll remember, he really wanted lawmakers to include an elimination of the debt limit as part of that temporary spending deal that they had negotiated. And ultimately, lawmakers left that out. And this goes back to what we were talking about with Mike Johnson. A number of the ultra-conservatives who were skeptical of him did not want to see the debt limit thrown out because they see that as a way of holding the government and Congress's feet to the fire on spending.
All right, Mike, we have a lot to look forward to. Looking forward to breaking it all down with you in the future. That, of course, is Bloomberg's Michael Shepard joining us from Washington. Now, still ahead, pop superstar Sabrina Carpenter and Dunkin' partner for a new iced coffee collab. We'll bring you all the important details.
Who is that?
That's Sabrina Carpenter.
I'm supposed to know who that is?
She had some hit songs in 2024.
Is she an actual carpenter?
No.
What? Matt, where
From the
have you
Carpenter
been?
family?
No, she's not. Name unrelated to the Carpenters. We'll talk about it in the commercial break. This is Bloomberg. All right, it's time now for Social Climbers, companies making waves this morning. And first up, Uber garnering a lot of Wall Street attention this morning. Goldman adding the ride-sharing companies to its U.S. conviction list, saying that it can deliver on its commitments despite the rise of self-driving vehicles. Meanwhile, you have JMP Securities cutting its recommendation on the stock because of the rise of autonomous vehicles. So we'll see how that tug of war actually shakes out, but shares currently up about 3.8%. Next up, we have a coffee collab worth talking about. Dunkin' partnering with espresso singer Sabrina Carpenter to launch a new drink called Sabrina's Brown Sugar Shaken Espresso. The coffee and donut chain also launched a $5 breakfast meal deal as it seeks to boost sales heading into the new year. And finally, forget Birkin bags. The Workin bag is tearing up the internet. Walmart's version of the iconic Hermes Birkin bag has taken off as budget-conscious buyers flock to the leather handbag, which has been nicknamed the Workin. Now, legit Birkin bags, they retail between $7,000 and $400,000, but the Workin actually clocks in at a wallet-friendly $78. All the supplies actually appear to be sold out at this moment. Let's get a check on these markets.
Hot.
What'd you say?
I like it. It looks hot. It looks good. It looks nice.
I mean, $78 too. That's not a bad price. I'm sure actually a lot of those supplies that have been bought up are now being sold for a couple $100s.
Yes.
But what do I know?
Depop.
Yeah, exactly. Let's take a look at markets right now. You can see currently higher by about 0.4% on the S&P 500, on the NASDAQ 100. We've seen a lot of volatility right now, though. You can see the line is moving higher and to the right. Take a look at the 10-year Treasury yield, currently lower by 4 basis points. That rally in the bond market deepening a little bit here, but we're still above 4.5% on your 10-year Treasury yield. Coming up, we'll talk with Snap-on CEO Nick Pinchuk as we head deeper into 2025. This is Bloomberg. Well, amid all of the optimism about a pro-business Trump administration taking over in late January, there's a lot of uncertainty when it comes to corporate America. And you have tools titan Snap-on, which mainly services professional mechanics, of course, calls on nearly 1 million vehicle mechanics every week and periodically calls about 300,000 businesses, and as such has a pretty unique view into the grassroots economy. So let's get to that now with CEO Nick Pinchuk, who joins us. Nick, first of all, Happy New Year. It's great to speak to you again. And
Happy New Year, Katie.
Let's talk about this uncertainty, because in your notes that you sent over to us, you talk about smaller mechanics and factory workers. Amid all this optimism, there's still a lot of question marks heading into 2025. Walk us through some of the main points there.
Well, look, I think the thing is that, I always said there was the financial and physical economy. The physical economy is like manufacturers and the people who work in those places, and that's even mixing now. If you talk to the individual technicians, the mechanics, the guys in the factory, the guys who twirl the wrenches and push the keys and stuff like that on diagnostic units, they're still pretty uncertain because their economy has been fairly positive all along. And so they recognize that. But what they are affected by more is by their feelings of the general environment, the two wars that keep continuing. The southern border, which is, kind of in chaos, they think got a little better now, but it's still a problem. The idea that tit for tat for China, the closing of the Red Sea that could lead to inflation, the idea that, okay, I'm looking at the prices and milk is still $4, over $4. That's up 30% versus pre-pandemic levels, and gas is up 18%. Not year over year, but versus pre-pandemic. And then the election, I don't think anybody knows what the president-elect's going to do at their level. They keep seeing it. I think it's like I said one time, welcome to the Mad Hatter's Tea Party. This is more like a roller coaster, and you're in the front seat and you're blindfolded. You don't know where you're going. And so, he's mentioned things like Greenland. The hits just keep on coming. And so for that group, they are still uncertain.
Got to buy it.
So there's not much change. If you look at the more organized people, the managers of the garages, the manufacturers, they're more positive. They've moved. The National Association of Manufacturers outlook has moved upwards. It moved down in the third quarter around the election time. Now it's moved upwards. And I think it's because they think that there's a hope that this administration would be positive toward business.
Hey, I want to ask about your sales specifically, Nick. We were talking about Tesla because they delivered fewer vehicles in 24 than they did in 23. And I was just thinking about tool sales. Do you do better automatically when more vehicles are sold outright, or do you do better when fewer vehicles are sold because we're working more to keep the used vehicles on the road? How does your revenue relationship work with the auto industry?
Actually, it's like this, Matt. Our revenue is driven by the cars on the road. So to put it in perspective, this year the American auto industry is going to be about 16 million cars sold. The cars on the road's almost 290 million. So the effect of the cars sold in any one year is a nit in our business. It can affect other pieces of our business, because in some cases we sell to the OEMs directly associated with launches of cars, and if they're more successful, then it works a little bit more for us. But the main business, selling to that 1 million mechanics, it don't make any difference. Over the long term, of course, it'll make some difference, and so that's the effect. But Tesla's view is whatever Tesla does doesn't really make much difference. It could make a difference if I think I've seen some of the analysis, and I think some of this is true, is that there's a rise in the popularity of plug-in hybrids over electric vehicles. Even in China, the Chinese are starting to make hay with those vehicles because they're not dependent on a charging infrastructure. And so therefore, if they move up over the long term, that introduces two different platforms into the cars on the road. That is, you have electric vehicles and plug-in hybrids, which are both internal combustion and electric vehicles. So eventually, that drives our business upwards because the changing of the vehicles is what makes our business go. Because every time they change, people need new tools, and that's music to our ears.
I want to also talk about what the sentiment looks like under the hood for smaller and mid-sized companies, because you're seeing this exuberance, of course, among the largest of companies on a lot of levels, the comeback of M&A, the idea of lighter regulations. But if you're a small to mid-sized company and you're maybe concerned about labor or about inflation, on average, do you think that the mood is better or worse?
Well, Sonali, look, I think the mood is clearly somewhat better. Remember, I said mixed. And you can see this in the National Association of Manufacturers indexes. They're moving upwards. It's a situation like this. They look at the administration as having focused on positive things for America. If you're a CEO, small or large, you like to see emphasis on your strengths. What you want to do is build your strengths, not necessarily worry too much about your weaknesses or your flaws. And so you could say, look, what is the administration talking about writ large? It is talking about reducing the weight of government on businesses, small and large manufacturers, and even small manufacturers, because small manufacturers are paying a bigger penalty. The National Association of Manufacturers again says that the average manufacturing group pays $25,000 per employee per year on regulation. Now, you can believe that number or not. I think it's pretty accurate. But small ones pay $50,000. So they like to hear that. They like to hear the idea that the administration might make the most of a great American strength, that is the American worker, and emphasize manufacturing. They like to hear the idea, believe it or not, that they restore the strength that immigration has always been, or restore immigration as a strength for our common power. They like that because they use those workers a lot. What they worry about, though, is things like the detail. There's tremendous windage in this. For example, you have the idea of, well, how are you going to actually promote manufacturing? Are you going to be able to do the what's going to happen in the tax cuts as the taxes expire? Now, there's a talk about corporate rates. Well, me personally, I don't think they need to lower the corporate rates. Very fine. Right now, where they are, they're about equal to other places for big companies. But small companies, which 93% of manufacturers are under 100 people. And so a lot of them are pass-throughs. So you raise the individual rates, that goes up. And if you eliminate the 199A deduction, 20% reduction on their EBIT, then that's a big impact for them. So they worry about that. They worry about the idea, well, what's going to happen with tariffs?
Right.
Tariffs are a big question, right?
Huge question.
And so you can do it two ways. You can have a tariff program which reacts to other countries which do bad things, subsidize and promote their state-owned industries, or you can do blanket tariffs. I think the former is the positive one, but they worry about the blanket tariffs.
Yep.
That kind of
and the kind of trade war that may kick off, and then the turn to China that you could see. We've been talking about that in this program the last couple of days. Nick, it's never enough time with you. I hope we can get you in the studio next time you're in New York City. Snap-on CEO Nick Pinchuk talking to us. Happy New Year to you.
Happy New Year, Matt.
Happy New Year. We want to break some news right now. Constellation involved in a $1 billion power deal with the U.S. government. And Constellation in power deals has been the story for the past year. Remember the Microsoft deal to bring back a nuclear power generator at 3 Mile Island. Now you have another boost for this energy company. Really, the power generators, I mean, wasn't the biggest gainer of all last year? Vistra, right?
Yeah, exactly.
500.
Yeah, Vistra, your big outperformer, but Constellation not too shabby either, gaining 91% in 2024. Of course, that Microsoft deal was a big boon for them, and clearly this new deal that they've announced with the U.S. government adding to that momentum on the first trading day of 2025.
I wonder what this is all going to amount to, because on one hand, there's a lot of excitement from AI companies to get into nuclear. On the other hand, you are seeing there was an amazing data visualization from Bloomberg News showing that this is already causing some stress on grids that are close to data centers. And so you might see a bit of a pushback on the local level as this gets done.
Yeah, absolutely. Maybe some deregulation is what you need there. Let's get a look at some of the stocks moving this hour other than Constellation. Bloomberg's Alex Semenova joins us, and we broke the Carvana story. Hindenburg going short on that stock, and what a volatile reaction, right?
Yeah, Matt, quite a swing on that stock, initially dropping as much as 8%, now up nearly 4% after Hindenburg took a short position in this company. This is, of course, the maker of those massive car vending machines. The stock did really well in 2021 and then weathered a rout back in 2022, and then has since kind of been recovering. Pretty good turnaround story there, but Hindenburg says that this turnaround is a mirage. They make some pretty gnarly accusations against the company in this report. They say that they manipulated their accounting, and they have lax underwriting that fueled temporary reported income growth, all while insiders cash out on billions in stock. And they're investigating this still. They're still saying that, you know, despite the results of the investigation, it is still exorbitantly valued, trading at an 845% higher sales multiple relative to some of its peers like CarMax and AutoNation.
Well, if Hindenburg is, of course, still in that short position, which TBD on that, they're getting some losses this morning. Carvana shares now up 3%. Let's talk about Tesla, though. Of course, disappointing when it comes to fourth quarter deliveries. You can certainly see that in shares. Yeah,
their vehicle sales dropping for the first time in a decade, and also deliveries coming in short of Wall Street estimates, though. That stock is actually pairing its loss. Wedbush's Dan Ives came out and said that he's still a buyer. Obviously, he's a big perma bull on Tesla. And also news this morning that one of its Cybertrucks exploded for reasons not totally clear yet. That was also weighing on the share price. But I got to point out, it's still up something like 60% since the election. Of course, you know, the company's seen benefiting from Elon Musk's relationship with Donald Trump.
Certainly the worst performer in the S&P 500 today. Not dragging down the S&P 500 index, though, or the Magnificent Seven. You are seeing a mixed trade of the Mag 7 stocks to start the year, aren't you?
Yeah, I actually want to point out that despite Tesla's performance today, Tesla and Apple have actually accounted for more than half of the Magnificent Seven's return since the election. So pretty incredible when you think about it. And obviously that group. What?
Both are down today.
Yeah, both names are down, but still doing really well in the past couple of months. But actually, that group, you know, going into this year, obviously facing much tougher earnings growth comparisons from last year. That group expected to post earnings of about 18% compared to 34% in 2024. And if you strip out NVIDIA, the AI darling, it's something like 3%. So obviously, investors are very wary of that, and a lot of investment firms, you know, advising clients to allocate away from the Mag 7 and diversify.
Tesla doubled after the election of Donald Trump, with his co-president, obviously, and is still up more than 56%.
I wonder what happens if they have a fallout.
I would love to know, and maybe we will find out. Who knows? I don't think he likes the term co-president.
You know,
no, he doesn't like that. No. I could understand.
Well, also watching last week of January, we start to get the earnings results from all of them. That will be a big moment of truth. Alex, we thank you so much. That is Bloomberg's Alex Semenova. And coming up next, we're going to talk about labor because U.S. port workers are threatening to strike again. We're going to have the latest on that next. Stick with us. This is Bloomberg. This is Open Interest. You're looking live at the Principal Room. Coming up next hour on Bloomberg Technology, an interview with Rachel Tipograph, the CEO of Micmac, an e-commerce business. This is Bloomberg.
U.S. dock workers and port employees will resume contract talks next week in hopes of avoiding a strike that would shut major ports on the East Coast and the Gulf Coast. The main issue to be resolved is whether employers can add semi-automated machines to port terminals, which the union sees as a threat to jobs. Joining us now with the latest is Brendan Murray. He is Bloomberg's trade czar. And Brendan, we've seen this movie before. Looks like we're going to get a sequel. What's the real threat here in terms of automation? I mean, how serious a threat is that to port jobs?
Well, the union would say this is, these are greedy, foreign-owned companies that are trying to automate port functions that they've done for decades. They view this, the union members do, as really a fight for their own survival. They got a 62% pay raise over the next 6 years in the last round of talks a couple of months ago. And now they're fighting to make sure that things like cranes and trucks and other machinery that operate around ports, aren't operated through remote control. So the companies are really going to try to push back on this because they're trying to make some money, and to do that they need to use the latest technology.
I also want to talk about what this means in terms of the threat of tariffs, because earlier your team has reported that in the port of LA alone, container shipments in November jumped 19%. You spoke to the Port of Long Beach CEO as well that expected the surge of imports to rise into this year as you have companies trying to front run what could happen under the Trump administration. What happens with that surge in imports as you hit issues between labor and management here?
Yeah, exactly. You have the confluence of a couple of different disruptions here, like you mentioned, the tariff, the front running, the pre-ordering of goods in front of the tariffs. You have geopolitical concerns like the ships going around, avoiding the Red Sea that uses up capacity in the shipping industry, and now the threat of a strike. It's all leading to disruption and sort of these unnatural flows of supply and demand. We saw a report today from one of the shipping pricing companies that said that shipping rates are going up. They've been up for the past 3 weeks. So the concern about those three things is really starting to tighten capacity and lead to disruptions and higher costs ultimately for importers and exporters.
In terms of what to expect from the Trump administration, I mean, it doesn't start until January 20th, but he had comments last time. How do you think the new president will react, and what kind of effect will this have on the beginning of his term?
Yeah, so like you said, he's already come out in favor of the union, the dock workers in this case, saying that he knows everything there is to know about automation, and that you can't really gain much more efficiency by using it at ports. So we would expect that the president would continue to support labor in this particular situation. The challenge for the port operators, the employers in this case, is to show that ultimately businesses and consumers, the ones who pay for shipping rates, will be at a disadvantage if they can't use these more automated higher technology kind of machinery. So that's the real challenge and the tension that you'll see play out in the next week or two.
Brendan, we thank you so much for covering this for us. That is Bloomberg's Brendan Murray. And of course, a lot of implications with shipping rates. You can also see some pressure on them, as he was saying, what that means for potential consumer pricing challenges in terms of inflation, and as well, of course, as you mentioned here, the president-elect's relationship with unions.
Well, especially at a time, I mean, we were talking in the morning meeting about a lot of importers are trying to get things in before potential tariffs set in. So these ports are busy.
A lot of political incentive, too, for the president-elect, the Republican Party, to side with the unions at this point in time. But anyways, we're going to shift gears. We're going to talk next about the hottest story right now on Wall Street. DE Shop posted big gains in 2024 with its top funds, some being the largest gains ever. We're going to give you details on that next in our Wall Street Beat. This is Bloomberg. And it's time now for the Wall Street Beat. D.E. Shaw expected to return billions of dollars to clients after notching an 18% gain for its flagship fund in 2024. We're going to get the details with Bloomberg's Nishant Kumar, because it's not just their flagship fund. You also have their second largest fund, Oculus, posting their record performance, 36% last year. These funds, these massive multi-strategy funds, don't always need to return money to investors at the end of the day. Is this something we're going to see from more funds that have posted double-digit gains this year, in the past year?
Surely, and we have reported about Point72's plan to return their profits this year. Citadel has been doing this for many, many years. D. Shaw is obviously, last year also they returned all their profits. At least this time they're returning only half of the profits, although the gains are much higher here. So this is one of the biggest problems that investors face these days in hedge funds. They want to allocate billions of dollars to these large multi-strategy hedge funds. It's just that these hedge funds are not willing to take their money. So this industry has hit the capacity limits. There is so much money they can keep managing and still continue to perform the way they have been performing in a market neutral type of strategies.
Right.
So this is the biggest challenge for investors these days.
Well, I want to meditate on that point a little bit more, because it seems like almost sort of a champagne problem that we're getting so big that unless we give back money, basically we won't be able to invest the way we want to in the markets that we want to unless we basically pare down here. It sounds like that's what you're saying.
Definitely. And also there are other limits, like there are all these hedge funds at the end of the day are highly leveraged. So there is a limit on how much money they can borrow as well. Plus, the industry is running out of talent. If you want to invest 10 billions more, then you need to hire dozens of people, dozens of portfolio managers who can deploy that capital for you. So it's a combination of all the problems that multi-strats face. They are victims of their own success, essentially.
Yeah, some of them are outperforming the S&P. Not many, almost none, actually. Does that matter to these investors that the benchmark index has better returns than these very expensive hedge funds?
Not really. So S&P 500 is not the benchmark for hedge funds, not for these multi-strat hedge funds. You go to multi-strat hedge funds to sleep well at night. You get less volatile, high sharp, alpha through these funds. If you want to replicate S&P 500 returns, you go to ETFs. So the comparison is not right. I know this is the most popular way to compare hedge fund returns, but it's not the right comparison.
All right, Nishant, great reporting as always. That, of course, is Bloomberg's Nishant Kumar. Meanwhile, let's get a quick check on these markets. Of course, a really choppy, volatile day to start 2025. But you take a look at the lines right now, and they are moving higher. The numbers are green, and maybe less so than they were pre-market, but the S&P 500 still higher by about 0.4%. Same story, too, if you take a look at big tech, with the NASDAQ 100 higher by about 0.4%, briefly erasing gains about an hour ago, but now recovering them. Then you take a look at the bond market. We had seen that bid sort of gaining momentum, maybe dissipating a little bit right now. You can see 10-year yields down by about 1 basis points. And we're in the danger zone.
The danger zone.
Yeah.
But, a third year in a row of gains for the index, at least so far.
It's one day, but yeah, let's see where it goes from here. And of course, we'll be watching that bond market and a lot of big guests coming up tomorrow on Open Interest as well. Keep an eye on everything in the C-suite and, of course, more on markets. This is Bloomberg.